Are asset values getting a little toppy?
Some are. I mean, this has been the case for some time. I mean, I think for us, really, it's the bond market that sticks out in terms of overvaluation, and equities still have quite a good relative valuation story to tell. I mean, the way that you could easily illustrate this, I think, is just looking at dividend yields. You've got a 2% dividend yield in the US on the S&P 500. That's more or less what it's been since the 1990s. Now, from 1950 onwards, most of the time, you've had a big difference between the dividend yield and the bond yield. Yep. Some say, you know, a little bit of extra compensation for that inflation risk you're taking with those fixed coupons. That's not there at the moment, obviously, with yields, with bond yields at 2%. So there's still a very strong relative argument to tell with equities, in our opinion. The other point to make with valuations, and I think this is kind of what she's hinting at, and she's saying it in a very soft language, if you listen to her, you know, that there may be some problem, but we can't say for sure, all that kind of thing, because the reality is that you can never tell what kind of earnings paradigm you're in. And I think, to illustrate that, what you can say is, if you look at the cyclically adjusted PE, you know, which is very popular nowadays, in the post-war period, pre-war, in the first half of the 20th century, it's about 13 times. Second half, it's 17 times, a little bit above that. Since 2000, it's been above 20. Now, some of that is explained by faster earnings growth. Some of it's explained by the fact that, you know, the plunging costs in assembling and maintaining a diversified portfolio of stocks. It's also a very different, you know, market nowadays. So there's a very difficult, it's very hard to say with certainty about sort of valuation metrics generally. The other point to make is that tactically, it's almost irrelevant anyway, because on a one-year horizon, if you look at valuations, and you look over the last 100 years, generally, the PE explains about 7% of the moves. If you move out to sort of 5, 7, and 10 years, that goes up to the kind of 30%, you know, in terms of R squared. But on a one-year time frame, valuation is almost irrelevant in terms of sort of the direction of stocks. So
keep buying stocks.
Keep buying stocks, because the economy, the US economic cycle still seems, the business cycle still seems to be ongoing. The stuff, the indicators that we look at tell us that there's further to run, that they're not the sort of overheating that you'd worry about just yet. So therefore, while the cycle continues, profits and earnings growth will continue. Therefore, shareholder compensation should continue to rise.